So ECM 570 going concern, and we always assess whether an entry is a going concern or not. But basically, what does it mean when we say that an entity is a going concern? We say that an entity is a going concern if it will be in operation in foreseeable future, i.e., in the next one financial year. Going concern if it will be in operation in foreseeable future, i.e., the next one financial year. It has no intentions. It has no intentions to cease trading, nor to liquidate, or seek protection. Seek protection from creditors. This is when we say an entity is a going concern. If it will be in operation in foreseeable future, yes, an entity will be in operation in foreseeable future, 1 year, in the next 1 year, or in one financial period, has got no intentions to cease trading, closing down, nor to liquidate. We know liquidation happens when you are winding up. You liquidate assets, use the sales proceeds to make good the obligation, or even seek protection from creditors. We know what happens when you seek court proceedings to declare you bankrupt as a person. We know this, that as a person you can take yourself to court, to request the court to declare you bankrupt. What are you doing at that point in time? You want to be protected from creditors. Because what you present in the courts is statement of affairs. Statement of affairs indicating that your obligations are in excess of the assets that you have. And as such, you are not able to make good your obligations. So this way you are protected from your creditors. They should not come calling to be paid when you are protected by a court of law. So if an entity has not in any way seek protection from creditors, has got no intentions to liquidate, no intentions to cease trading, then this is a going concern. Let's look at the effects. Let me give you the correct subtopic about the accounting implication. So the subtopic should read consequences. Consequences of going concern. Consequences of going concern. Consequences of going concern. Stroke implications of going concern in the financial statements. Consequences of going concern, stroke implications of going concern in the financial statements. Implications of going concern in financial statements. Implications of going concern in the financial statements. Implications of going concern in the financial statements. In the financial statements. So we start by asking ourselves, what happens when an entity is a going concern? When an entity is a going concern, this is where you find yourself preparing a statement of financial position. Yes, a statement of financial position. A statement of financial position, stroke balance sheet is prepared. So get this right. When you find a client preparing a balance sheet, then these are going concern. Because the assumption is, you know that in the balance sheet, we record balances carried down. All the balances carried down find themselves in the B sheet. See, when you do the creditors account, then you have opening balances, for instance, then several transactions, then you have your balances carried down. This carried down finds itself in the B sheet. All the carried downs in the assets account, in the expenses account, in the incomes account, in the liabilities account, balances carried down find themselves in the balance sheet. Because the assumption is those balances carried down will become the opening balances because the entity is a going concern. We are not intending to close down. That's why all the carried downs will be recorded in the B sheet. What components do we record in the B sheet? We will have non-current assets. Non-current assets, for instance, plant and machinery. We record it in the B sheet. The assumption is this asset will be used for its entire estimated useful life. It's used for its entire estimated useful life, which could be 4 years, 5 years, and so on, plus its value recovered. Its value recovered through use. Its value recovered through use. That we are not disposing it off to get the liquid cash to make good obligations. No, the value of this asset will be recovered through use. As we use it, and you use it, then the accumulated depreciation, I believe you know this is a non-cash expense. It's a non-cash expense. You always record it under the adjustments in the cash flow statements. Net profit before tax, then adjustments. You add back depreciation because it's a non-cash item, which is reducing our net profit. Yes, does not record any cash outflow. We know that these accumulated depreciations are used to replace this asset after its entire estimated useful life. So we are saying that this asset will be used for a long period until we recover it through use. Then the current assets, the value of the current assets will be recovered in the normal running of the business. In the normal running of the business. What do you mean by in the normal running of the business? That stock items will be sold. Maybe we will sell them on credit. We'll have some debtors. Maybe these debtors will pay us through check. We'll deposit in the bank. Then this will be converted into cash, of course, after the check clears. These are current assets. But these current assets will be recovered through normal running of the business. And so are the liabilities. That the liabilities will be made good in the normal running of the business. This is when an entity is a going concern. Otherwise, when a going concern ceases to be, then we talk of abandonment. We talk of abandonment of going concern. We prepare books of accounts on breakup. Basis. Instead of preparing statement of our financial position, we prepare statement of affairs. This sometimes back I mentioned how it used to look like. Editorial syllabus, we used to do it in bankruptcy accounts, in financial reporting, intermediate level. We could record net book values, net realizable values. Then we have the details here, and details will have some sharings here. Then we record what used to start. Yeah, we used to call them a fixed charge. The assets with a fixed charge, for instance, we would record we've used our land and buildings. You've used our land and buildings, which are worth 20 million. So our sharings are in thousands up there, 20 million. Then we had a debenture, which we need to pay 18 million, for instance. Kumaanisha tukiuza hiyo land, net realizable value. Check this, net realizable value. Unlike in the B sheet where we record the net book values. When an entry is a going concern, we record the net book values. When going concern ceases to be, we record net realizable values. How much can we realize? So since these are fixed, charged, or else this asset has been taken up with a fixed, as a fixed charge. So when we dispose it off, we are left with the excess of 2 million, because the land and buildings are worth 20 million. The loan which has been secured using these assets is to the tune of 18 million. So when you dispose, you have 2 million, which is excess. Then, of course, the net book value here. Maybe the net book value could be 16 million. It could be any figure because it's cost less accumulated depreciation. Then you record other assets that we have here. We could be having some motor vehicle, like net book value of 2.4 million. But when we go out there to sell, it can fetch 1.8. We have so many other assets. This is 3.8. We don't even add here. We are not interested in book values because going concern has ceased to be. We want to see how much this can fetch. Now, coming to pay, these are the assets that we have. We want to pay our obligations. We first record this one. We start with the debentures. It's 18 million there. So we are paying 18 million. It was secured through land and buildings, 20 million. We subtract. Here we put dash. The reason, in this 2 million, it's net of what you are paying to the debenture holders. So the money to be paid to the debenture holder has already been set aside. It's not included in this 3.8 million. So we've paid those who have got a fixed security and the fixed charge and our assets. Then from here, we start paying our preferential creditors. We pay our preferential creditors. Maybe they were around 700,000. So you pay them 700,000. You're subtracting, we are at 3.1. After paying our preferential creditors, we may secured, preferential, we come to unsecured creditors. Maybe they were worth 2.8. There's 2.8. We less how much is remaining here, 300,000. Then we move to our deferred creditors. That of course, there are those whom we may not be able to pay, or maybe we will even have excess of 200,000 sharings, so we'll pay our shareholders. We know our shareholders are the ones who get the last bit of any excess monies remaining. This is what we refer to as statement of affairs. It's a topic that again has been removed in auditing. In auditing, before the review of the syllabus, we had a topic referred to as receivership and liquidation. Receivership and liquidation used to be there in auditing. So in our auditing procedures, number one is to ensure that statement of affairs have been properly prepared and we have given preference to the secured creditors, then preferential in this order. These are some of the things that we used to verify in our audit procedures under receivership and liquidation. Now, you're saying when an entries are going concern, we are preparing statement of financial position. Our assets are classified as even and current, intangible and current assets. Our liabilities are even and current liabilities and current liabilities. But when a going concern ceases to be, we prepare statement of affairs. This classification ceases to be. We are no longer talking of non-current and current. Assets will talk of free assets, because we even have some free assets here. These are the ones which have been taken as a fixed charge. We have free assets. Fixed charge and those which have been attached have got some encumbrances. Yes, liabilities are no longer classified as non-current liabilities and current liabilities. We are talking of secured preferential, unsecured, deferred. This is when the going concern ceases to be. You are preparing books of accounts on a breakup basis. It's a very important concept to get. And this is what the auditor will be checking. Yeah, that's why we assess the going concern position of the client. Both management and the auditor, both management and the auditor are concerned about the going concern position of the entity. Why? So that the management can prepare the books of accounts the way it should be. That if it's a going concern, they prepare as such. If there is abandonment to going concern, they prepare this as such. What's the interest of the auditor? To assess whether there is proper going concern assumption during the preparation of the financial statements. And this is where both of them will be checking about financial indicators of going concern problems. Remember, we listed this under financial risks, and I told you that we will use this point somewhere. What are the financial indicators of going concern complications? Adverse key financial ratios, dividends falling in arrears, working capital items being negative. This is current liabilities in excess of current assets. Those are financial indicators of going concern problems. When we look at the operating indicators, issues of turnover, lots of errors, frauds, irregularities, computer systems breakdown, over-reliance on a single product, over-reliance on a CEO, all those are operating indicators of going concern problems. Then we talk of other indicators, where we said that and other indicators will combine compliance risks, and external compliance risks and external risks. Components, external risks. Right, let's write this story in a summarized form. So, the going concern assumption means that 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 assets and liabilities are recorded. Assets and liabilities are recorded. Assets and liabilities are recorded on the basis that the entity will be able to realize. The entity will be able to realize its assets. The entity will be able to realize its assets. Entity will be able to realize its assets and discharge its liabilities. In the normal course of business. Realize its assets and discharge its liabilities in the normal course of business. Realize its assets and discharge its liabilities in the normal course of business. That's what we have said, yes, that in the normal course of the business, we'll be able to realize all our assets and make good our obligations, i.e., Roman number one, assets are recognized. Assets are recognized and measured. Assets are recognized and measured on the basis that assets are recognized and measured on the basis that the enterprise expects to recover. On the basis that the enterprise expects to recover through use. Enterprise expects to recover through use. Enterprise expects to recover through use or realization of the recorded amounts or realization of the recorded amounts or realization of the recorded amounts full stop. It means that the plant and machinery, for instance, it means that the plant and machinery, for instance, the plant it means that the plant and machinery, for instance, is expected to be used. Plant and machinery, for instance, is expected to be used for many years in the future. Is expected to be used for many years in the future. Expected to be used for many years in the future. And the net book value recovered through use. 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 Full stop. That's what we had indicated. That all the non-current assets will be covered through use. Roman number two. Liabilities are recognized. Liabilities are recognized and measured. Liabilities are recognized and measured on the basis that liabilities are recognized and measured on the basis that they will be discharged in the normal course of the business. Recognized and measured on the basis that they will be discharged in the normal course of the business. They will be discharged in the normal course of the business, discharged in the normal course of the business, i.e., the balance sheet shows the creditors due. The balance sheet shows the creditors due. The balance sheet shows the creditors due after 12 months. The balance sheet shows the creditors due after 12 months and due in less than 12 months. Due after 12 months and due in less than 12 months. Due after 12 months and due in less than 12 months. In short, you're saying we have non-current liabilities and current liabilities, because non-current, these are liabilities whose repayment period is in excess of one financial period. Current liabilities have to be made good within one financial period. Perfect. Skip a line and say, the breakup basis, i.e., the abandonment of going concern basis, the breakup basis, i.e., the abandonment of going concern basis, means that the breakup basis, i.e., the abandonment of going concern basis, means that the abandonment of going concern basis means that Roman number 1, the net assets will be valued. The net assets will be valued at net realizable values. Net assets will be valued at net realizable values. Will be valued at net realizable values. We've seen that. Net realizable values are what we are recording in our statement of affairs. Roman number 2, All liabilities will be shown. All liabilities will be shown at the amounts due. All liabilities will be shown at the amounts due. All liabilities will be shown at the amount due. Will be shown at the amount due. We've seen that, although unakuta kwamba the book values or the much that we owe them, unless there's a discount to be given. Sometimes you're told if you're paying before this date, you'll be given a discount of these amounts. So these figures could be different. The actual amount that we owe to our creditors. Subtopic: Directors' responsibilities. Directors' responsibilities in relation to going concern. Directors' responsibilities in relation to going concern. In relation to going concern. Ndio nikakueleza board management and the auditor have to keep on reviewing the going concern of an entity so that the management can get it right on how to prepare the financial statements. Is it on going concern basis or is it on breakup basis? Sorry, answer. The directors of an entity should review. The directors of an entity should review the going concern. Directors of an entity should review the going concern and its continued use. The directors of an entity should review the going concern and its continued use in preparation of financial statements. Review the going concern and its continued use in preparation of financial statements. In preparation of financial statements. All right. Another paragraph on the same say. For this case, the directors should review. 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 Number one, nature of the business. Nature of the business. Nature of the business. Nature of the business. Number two, riskness of the company or industry. Riskness of the company or industry. Riskness of the company or industry. Number three, external factors. External factors. External factors. Number four, the budget and strategic plans. 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 Number five, other factors written in the going concern. So number four, we've talked of the budget and strategic plans. Number five, other factors written in the going concern. Other factors written in the going concern. Other factors written in the going concern. All right. Subtopic under that, threats to going concern. Threats to going concern. Threats to going concern. So tumeshaziandika, we can just give just a few examples. When we recall, we can make reference to the risks. Say, these are factors that would indicate, these are factors that would indicate, these are factors that would indicate that the going concern assumptions are threatened. These are factors that will indicate that the going concern assumptions are threatened, comma, compromised. You're saying these are factors that will indicate that the going concern assumptions are threatened, comma, compromised, comma, put into question, etc., etc. Threatened, compromised, put into question, etc., etc., put into question, etc., etc. They include A, financial indicators, financial indicators, i.e., we just give like 3 examples because you already have the points. Number 1, excessive reliance on short-term borrowings. Excessive reliance on short-term borrowings. Loans here and there. Number 2, adverse key financial ratios. Adverse key financial ratios. Nakuta ratios are adverse. Number 3, dividends falling in arrears. You have declared dividends, but you are not in a position to pay. Dividends falling in arrears. Next, necessary borrowing facilities that have not been agreed. Necessary borrowing facilities that have not been agreed. Necessary borrowing facilities that have not been agreed. You need to be financed, but the financier is yet to agree to finance you. Next, shortage of operating cash flows. 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 Next, current liabilities exceeding current assets. Current liabilities exceeding current assets. Current liabilities exceeding current assets. Current liabilities exceeding, and so many other points that we can list down there, and so many other points. Let's look at B, operating indicators. Operating indicators. Operating indicators. Operating indicators, i.e., number 1, high turnover of key staff and management. High turnover of key staff and management. High turnover of key staff and management. Here, this destabilizes the operations of an entity. High turnover of key staff and management. Number 2, loss of major customers. Loss, L-O-W-S. Loss of major customers. Loss of major customers, comma, suppliers, comma, market or license. Loss of major customers, suppliers, market or license. You need to do franchising. You may lose a market, a license to franchise, meaning that you're no longer in business. Next, frauds and irregularities within an entity. Frauds and irregularities within an entity. frauds and irregularities within an entity. We know that there are some frauds which may cripple an entity, may cripple its operations, etc., 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 etc. All right, subtopic: mitigators of going concern problems. Mitigators of going concern problems. Mitigators of going concern problems. We may have so many mitigators, but we have the main ones. That's why we shows it sound. So I can have them written mitigators. How do we get out of going concern complications? Number one could be dispose or sale, stroke disposal of non-current assets. Yeah, we see this even at personal level sometimes. As you face some cash problems, you have an excess assets. You have excess assets. You find yourself disposing an asset, disposing a piece of land, disposing a car, disposing a motorbike. Then you use that cash to bail you out of going concern complications. Yeah, but as an auditor, you need to confirm some things here. You need to confirm some things. When the client has chosen to dispose an asset, you need to confirm number one, that the client disposed an idle asset. Disposed an idle asset. That's something that as an auditor you need to confirm. Because if care is not taken, one may fall from frying pan to fire. Yes, that at personal level, you are not able to raise rent. You dispose the gas cooker to pay rent. Then in the evening, you can't cook. I mean, you're falling from one problem to another complicated problem. So that's why, as an auditor, you want to confirm that the client has disposed an idle asset, but not actively utilized asset. Plus, you need to confirm, you need to review the reasonableness of sales proceeds. You need to confirm, review the reasonableness of sales proceeds. There's a topic we'll be discussing next on Saturday, issues of related party. A related party may be the one benefiting from this. Yes, that the company sells at a very low price, because we have a related party who is benefiting. Here, an entity is selling a piece of land, a house somewhere, at a very low price, not knowing that maybe it's the director group proxy who is buying this. That's why, as an auditor, we need to assess the reasonableness of these sales proceeds. Number two, we talk about a rescue package. Rescue package, which involves converting creditors to shareholders, stroke equity to equity. Yeah, you convert creditors to equity. So what happens now? You cannot own yourself, because now you've become owner of the business. Yeah, there's a college which did this sometimes back. It owed its lecturers 11 months salary. So when they resumed in January, they agreed, we can't be able to pay all this. Let's convert these salary arrears to equity, then you become directors. That's how they found themselves becoming directors. Yes. So what do you need to do as an auditor? Review the minutes. Use the minutes to confirm that creditors consented to conversion. Consented to conversion. Yeah, check the minutes. It could have been a meeting during the AGM. It could be creditors' meetings. Access those minutes that they agreed to be converted to equity. They agreed to be converted to equity. Number three, a very important rate, which sometimes it was tested on its own, comfort rate. You talk of comfort rate or letter of support. Comfort rate, stroke letter of support. Comfort rate, stroke letter of support. So what happens here? Maybe in a group structure. Let's say we have the parent here. We have the subsidiary here. We have subsidiary. Subsidiary. You will find that the subsidiary is facing going concern problems. While parent is financially sound, subsidiary is financially sound. Yeah. So we may, or the parent may agree to support the subsidiary financially or otherwise. Nakuta wanaweka pesa kama vile what was happening between Tuskys and Nakumatt before they both crossed down. I remember that Tuskys had agreed to support Nakumatt. They had agreed that the suppliers who supplied to Tuskys go supply to Nakumatt, then Tuskys would act as guarantor. That in event Nakumatt is still unable to pay, Tuskys will stand in. That is letter of support. And that's what I'm talking of, supporting financially or otherwise. Supporting financially or otherwise to build out an entity out of going concern problems. We see this even happening sometimes with siblings in a family. Several of them are financially stable, others are still struggling. You find that there could be an element of supporting. Let's support this one. Let's establish a business for them so that they are financially stable also, and so on. The support must not come from components in a group structure. We could be having even an ABC Limited here, agreeing to support this ailing subsidiary, financially or otherwise, financially or otherwise. So as an auditor, you need to confirm that the one promising to support is in a position to support. Because again, you can't give what you don't have. Remember that rule, remember that for Manhattan. You check about the ability of the supporter to support, and then you check the enforceability of the arrangement. Is it enforceable in a court of law if they fail to execute? Is it something that you can follow up in the court of law to seek specific performance? Here to return a specific performance is a remedy in equity. It is a remedy in equity. So I'll do a number on a confirm as an auditor. The possibility and enforceability, you'll find that question in the past paper, that what are you likely to find in the letter of support? We'll be looking at it in the past paper. So I didn't say a question. And that's it. A good structure and the comfort rate.
Within the group and
They can support, they can support each other. Within the group, they can support each other. So let's say the subsidiary is owing financially, is facing financial distress, while the parent and some subsidiary are financially healthy. They can go ahead and support the ailing entity. So the point I've added is the support must not come from the components in a group structure. Even an outsider can go ahead to support. So the support is not restricted to group components only. Even an outsider may come in to support an entity which is not, you're not in the same group structure. So it's either support coming from within the group structure or elsewhere, outside the group structure. It's a good question. Yes, online family are facing sound issues. All right. Say, in some situations, one company within a group of companies, in some situations, one company within a group of companies, one company within a group of companies, one company within a group of companies, e.g., a subsidiary company, e.g., a subsidiary company, e.g., a subsidiary company may be facing going concern problems, 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 while the other companies, e.g. holding company, while the other companies, e.g. holding company, may be operating normally, while the other companies, e.g. holding company, may be operating normally, may be operating normally, may be operating normally. Full stop. Another paragraph. In such a situation, the directors of the subsidiary company, the directors of the subsidiary company, we're saying in such a situation, the directors of the subsidiary company may obtain a letter of support. May obtain a letter of support from the directors of the holding company. Obtain a letter of support from the directors of the holding company. Letter of support from the directors of the holding company, indicating their willingness to provide financial assistance, indicating their willingness to provide financial assistance, indicating their willingness to provide financial assistance, All right, subtopic auditors. We're tunaandika auditors. What do auditors need to do? Auditors down there have auditors. What's the task of the auditors when there is such an arrangement? Auditors write and say, in such a situation, the auditor should obtain copies of such letters. The auditor should obtain copies of such letters. In such a situation, the auditor should obtain copies of such letters and confirm their commercial viability. Obtain copies of such letters and confirm their commercial viability. And whether they have the capacity, to provide such support. And whether they have the capacity to provide such support. And whether they have the capacity to provide such support, Very important about the letter of support. Next, number four, negotiating with shareholders. Number four, negotiating with the shareholders, to put in more share capital, to put in more share capital for purposes of bailing, out the entity. Yes, shareholders to put in more share capital for purposes of bailing out the entity. We've seen this happening, and especially where the government is the sole shareholder or the major shareholders, like for Uchumi Supermarkets, government has pumped in a lot of cash, trying to bail out Uchumi out of the going concern complications. The same case, we see even Parliament allocating some funds to Kenya Airways. It's allocating some funds to boost it to remain afloat. That's what we mean. Negotiating the shareholders to put in more share capital, purposes of bailing out the entity. What will the auditor be checking here? Basically checking through the minutes, just like in the sale, just like in the rescue package. We need to review the minutes to check that the shareholders agreed to bring in more cash. So I can say, where this arrangement is in place, the auditor should obtain copies. The auditor should obtain copies of resolutions passed. Auditor should obtain copies of resolutions passed, by the shareholders, copies of resolutions passed by shareholders in accepting to put in more shares, passed by shareholders in accepting to put in more shares, in accepting to put in more shares, Walikubali, did they agree to such an arrangement, the last one that we'll discuss? Number five, negotiating with creditors and suppliers. Negotiating with creditors and suppliers. Negotiating with creditors and suppliers. What happens here? It happens even at personal level sometimes, that now negotiate with creditors. I owe you this much, kindly. Can we come up with a repayment plan? This happened during COVID. Yes, we were given that review, or that opportunity to negotiate with the banks, or to reschedule a repayment, sometimes to suspend payment until further notice, negotiate with the creditors on the reviewed another repayment plan. Then negotiate with new suppliers that they supply you to make sure that you remain afloat. So creditors negotiate about the repayment terms and period. New suppliers to agree to supply you on certain terms, like the way we saw G2G arrangement, that those Gulf countries would supply us with fuel for how many months without paying? It was running for how many months? The G2G arrangement with the Kenyan government. Maybe here ilikupita. Serikali yetu na ingine walikubaliana 6 months. Yeah, they supply fuel to us for 6 months without paying. These are 6 months, I guess they have lapsed. I believe so, because what we are doing, and then I don't know, this maybe why Kenya shilling is gaining against dollar. It has gained for some time. Is because the reason was to reduce the demand for the dollar. Because the Kenyan government was paying so much on monthly basis on fuel supply. This increasing the demand for the dollar, having a negative impact to our Kenya shilling. So they agreed with the Gulf countries that they supply us with fuel for 6 months without paying. Then the 7th month, this is when we pay what was supplied the first month. 8th month, that which was supplied for. So they're still supplying. Yeah. So such an arrangement can be agreed that kindly supply us for the next 6 months. It is the 7th month that we start now paying. By that time, we may have gotten back to our food as far as our operations are concerned. EOG to G, opposition was saying there's corruption happening and other things, but it happened. It really happened. All right, like this. Where there may have been disagreements, where there may have been disagreements with original suppliers, there may have disagreements with original suppliers, comma, directors may consider negotiating with new suppliers, directors may consider negotiating with new suppliers in order to ensure continuity in their operations. In order to ensure continuity in their operations. Ensure continuity in their operations. Ensure continuity in their operations. Full stop. The directors may also engage the creditors. The directors may also engage the creditors. The directors may also engage the creditors. The directors may also engage the creditors to restructure and reschedule. To restructure and reschedule the repayment terms. 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 All right. What is the auditor doing about it? Yes, auditors. Watafanya namna gani? What are they doing about it? Auditors. So I can say the auditor should confirm. The auditor should confirm with both the new suppliers. Auditor should confirm with both the new suppliers as well as the creditors. Confirm with both the new suppliers as well as the creditors, that they are agreeable to the terms. 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 And those are the points that we have. What other ways do you think that we can get out of the going concern complications as a corporate? Maybe some points that are not included here. How else? About these are the main ones. Yes? Yes, mergers and acquisitions. Yeah, what happens in mergers and acquisitions? We benefit from financial synergy. Financial synergy. Financial synergy. You were in going concern complications. I heard a musician giving a gospel musician giving her story, and she said she got married because of financial constraints, that she could not raise some money to pay rent. So you met a boyfriend where you could share rent, pay this, I pay this. You get out of the going concern complications. Yes, mergers and acquisitions, very true. You can add that, it's very much applicable. Mergers and acquisitions, mergers and acquisitions. You merge, you benefit from financial synergy, expertise synergy, and so many other synergies. Any other points that we can add? Good, that's it, that's it, that's it. The directors to negotiate with shareholders to forego the dividend payment. Lord Samuel online is adding this. Liquidation. It's the directors to negotiate with the shareholders to forego the dividend payments. And because these are our creditors, we capture these as indicators of going concern complications. Dividends falling in arrears. Either they can agree to forego or to suspend until a later date. This be paid at a later date. We are being told reduced borrowing may not be possible because when you're already facing the concern problem, it may be the way out. I don't know whether even at personal level you've ever found yourself in such a situation. Salaries have just been paid, you've exhausted the salaries, you've exhausted your savings, and you still need money. Borrowing could be the only option. And that's why we've said when we have financials withdrawing or borrowings which have not been certified is an indicator of going concern complication, because it could be the only way out. The only way out. Yeah. So we have those other points that are coming up. The shareholders can forego or suspend their dividends. They are part of the creditors. They are part of the creditors. They are part of the creditors. All those that we owe are our creditors. Yeah, we can always negotiate with them that we pay them at thanks for all those input. I'm saying in an exam. Yes, reducing number of staff. We've seen entities reducing number of staff. Actually, they notice it a very good name. They don't talk of retrenchment. They talk of downsizing. Yeah, we are downsizing to ensure that we continue remaining afloat. Use reserves share premium. Reserves, zitasaidia. You know, reserves are not tangible. Yes. We're already in a crisis. Yes, so that's what I'm saying. Yeah, plus crisis will not have financial impact per se. Yes, but Ahmed Siad is giving us this point. I need to research on that. Whether reserves can chip in. That one I may not be very sure about it. All right, we know something else. Audit procedures on going concern. Audit procedures on going concern. Yes, please. They are not procedures. They are not procedures. It's about the task that the auditor should do, or basically what the auditor should do to assess the viability. Because what's happening is we are in crisis. So the auditor is reviewing this to check whether is this really bailing the entity out of the going concern problems. So they are not audit procedures per se. They are not audit procedures per se. It's a matter of assessing the viability of what the management has chosen as a way of bailing out the entity of the going concern complications, assessing the reasonableness, assessing what we call arm's length, yeah, assessing the arm's length. So we may regard them as sub-audit procedures. They are not the audit procedures and going concern. To relate activities to matters.
They do to me.
Yeah, it could be referred as auditors' activities, auditors' responsibility with regards to the bailing out of the going concern problems. As such, those to some extent we may call them audit procedures, but I don't want to use that one so that it does not confuse you. In an exam, if you ask about audit procedures, they're not asking about these ones. Yes. Otherwise, ukiangalia na macho ya kiroho, they look like procedures that auditors execute with regard to specific items. But in an exam, they are not the audit procedures. They are not the audit procedures. Yes, it's the ones that we want to look at now. Audit procedures from going concern. It's a good question to ask because at this advanced level, you find that from question 1 to number 5, all of them are testing on audit procedures. If you check your past papers, it's possible to have all the questions from number 1 to number 5 testing on audit procedures. You find question number 1, audit procedures on PFI. We'll be discussing PFI in topic number 6. Question number 2, audit procedures on environment. Audit procedures on going concern. Audit procedures on group. Sometimes the client has bought some piece of land with some building which needs to be demolished to construct a modern house. They want you to highlight audit procedures. Number 1 to number 5. So it's good to seek clarity on which are these audit procedures that we are talking of. It's about assessing now with regard to this topic, ISA 570. How do auditors review the going concern position of the client? How do auditors review the going concern position of the client? I think I need to give this in summarized way. Number 1, we review minutes. Minutes are a very rich source of information. So we need to review or read the minutes like we're towards the end of the month. Entities could be meeting, the directors could be meeting, discussing how do we raise salaries? How do we raise rent moving forward? The cash position we are in is wanting. What do we do? Should we dispose our plot which is in a certain area? We'll be able to get these amounts of money. We'll be able to, so minutes can be a very rich source of information. Previously, you may not know that the client is facing going concern complications, but by checking through the minutes, you get very valuable information about the going concern complication. Yes, it's talking of reading minutes, checking management on interim accounts, amongst others. All right. So number 1, we've checked reading minutes of the meetings of shareholders. Reading minutes of the meetings of shareholders. Reading minutes of the meetings of shareholders and directors. Reading minutes of the meetings of shareholders and directors for reference to financing difficulties. For reference to financing difficulties. For reference to financing difficulties. Minutes, we captured these when we were discussing ISA number 310, background research. We discussed what we want to know and where we get this information from. Point number 1 was minutes, because it's a very rich source of information. Number 2, analyzing and discussing. Analyzing and discussing entities latest. Analyzing and discussing entities latest interim and management reports. Analyzing and discussing entities latest interim and management reports. Entities latest interim and management. Like what we are doing in the office, there are books of accounts you are preparing now. they can share some light. We can see the cash book, the cash inflows, the cash outflows. These are the management accounts that you're preparing. They can guide us on assessing the going concern issues. Number 3, analyzing cash flows and profits forecasts. 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 Yeah, how do you project the future? Because as we'll find out, and this is number 810, projections, we need to be reasonable when making estimates. So when you look at the estimates, that's why you find, like banks, when they want to give some loan, they may require you to avail projected cash flow statements because it can show your projections. How do you plan yourself to make good the loans that will be granted? So that's why we're checking the projected figures. Number 4, reviewing terms of debentures. Reviewing terms of debentures. Reviewing terms of debentures and loan agreements. Reviewing terms of debentures and loan agreements. Reviewing terms of debentures and loan agreements to determine whether it has been breached. Terms of debentures and loan agreements to determine whether it has been breached. To determine whether it has been breached. To determine whether it has been breached. It has been breached. Kenya was at the brink of breaching the Eurobonds. Yes. Which other African countries have already defaulted their Eurobonds? 2 countries have already breached it. Angola. Is it Angola? And Ethiopia is one of them also. Yes. Yeah. Can imagine a country defaulting a loan. It really affects. Online family, you've come across this information. I believe it's Ethiopia is one of them, Angola, or they even 3. Somebody is touching you can see which countries have already defaulted. So that's why Ruto used their county funds to pay the loan. Otherwise, we're at the brink of being blacklisted. That's why he was not able to pay. Yes, it affects our currency, it affects our credit rating. Yeah. Okay, so it's unstable. Yeah, we have Ethiopia and Ghana. Angry is talking of Ghana. Kisi College is talking of Ethiopia. Yeah, you can recall Ethiopia is one of them. So Kenya tuliponea. But we are still not out of it yet because we have other boards which are maturing very soon. And they need to be, yes, Ghana and Ethiopia. So, but for now, we are safe. That's why he borrowed cheaper loans to pay these other. Even at personal level, sometimes you find yourself in such a situation. You borrow to pay, at least to ensure that you are not blacklisted. Zambia and Ghana. Zambia and Ghana. I believe Nigeria was Ethiopia. Yes, we are almost there, including Kenya, Morocco, Nigeria, Ghana, and Egypt. Yes. Yeah, so even an entity, even a country can face going concern complications. Yes, equivalent, it's no longer a going concern. Perfect. So what we are saying, reviewing terms of debentures and loan agreements to determine whether it has been breached. All right. Number 5, inquiring from the entity's lawyers. Inquiring from the entity's lawyers. Inquiring from the entity's lawyers. Inquiring from the entity's lawyers regarding existence of legal suits. Regarding existence of legal suits, regarding existence of legal suits, inquiring from the entity's lawyers regarding existence of legal suits, comma, their outcomes, and estimates of the expected loss. Legal suits, their outcomes, and estimates of the expected loss. Legal suits, their outcomes, and estimates of the expected loss. And estimates of the expected loss. Number 6, considering the entity's plan, considering the entity's plan to deal with unfulfilled customer orders, Considering the entity's plan to deal with unfulfilled customer orders. The reason why we discuss this point is, most of the time, you find that if it's a producing entity, it closed down when some customers had already placed some orders. Like the way banks close, like in Chase Bank and Imperial Bank. Somebody might have deposited some cash yesterday. And today in the morning, unakuta kwa mlango to esteemed customers, we apologize, ABC. So what we are planning to deal with such clients' funds? Unfulfilled orders. You have placed an order of Mabati somewhere in a company which produces this, then they have closed down. We need to see the plans they are putting in place to deal with unfulfilled customer orders. Next. Confirming the existence, comma, legality, confirming the existence, legality, and enforceability. Confirming the existence, comma, legality, and enforceability of arrangements. Confirming the existence, legality, and enforceability of arrangements to provide or maintain financial support, existence, legality, and enforceability of arrangements to provide or maintain financial support with related or third parties. Provide or maintain financial support with related or third parties. Yeah, we say the related party, these are related parties. That's how we find them. And it's a number of the 50. IAS number 24. Components in a group structure are related parties. Then third parties, when you have an outsider coming in to support a component in a group structure, we are checking the existence, legality, and enforceability of such arrangements. Next. Confirming events after the period end. Confirming events after the period end. Confirming events after the period end. To identify those that either mitigate. To identify those that either mitigate. To identify those that either mitigate or otherwise affect. Identify those that either mitigate or otherwise affect the entity's ability or otherwise affect the entity's ability to continue as a going concern or otherwise affect the entity's ability to continue as a going concern, otherwise affect the entity's ability to continue as a going concern. That's a question that was tested last sitting, intermediate level. Yeah, they were asking the relationship between going concern and subsequent events. The relationship is there are some subsequent events which may mitigate the going concern complications. Other subsequent events will worsen the situation. For instance, there was an ongoing court case, then you end up losing the case, and your building is to be demolished. So it's a subsequent event which affects going concern negatively. Let's say you win the case and you have to be compensated. It's a subsequent event which brings the entity out of the going concern complication of the going concern complication. Last number 9, I think I'll share these notes down and somewhere I'll be suffering from some sound hiccups. Number 9, seeking written representations from management, seeking written representations from management, seeking written representations from management regarding its plan, seeking management representations from management, seeking written representations from management regarding its plan for future action, regarding its plan for future action, regarding its plan for future action, regarding its plan for future action. Yeah, that's the last point. Even if you checked what we listed down under the subsequent events, number last, we always seek management representation letter. We'll be looking at it at a later stage to have a proper understanding of what it entails. Subtopic: conclusion and reporting. 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 Kuna point moja hapa watu huwa wanaisahau, and I emphasize it now. Check this. The auditor reports on appropriateness or inappropriateness of going concern assumption. That's what the auditor reports on. So if the going concern assumption is appropriate, the auditor will give a clean report. If the going concern assumption is inappropriate, this is when the auditor will modify his report. Let me give you an example. If an entity is a going concern and the client has prepared a balance sheet, then the going concern assumption is appropriate, we will issue a clean report. We will issue a modified opinion. But if an entity is not a going concern, it is not a going concern, and we have prepared the books of accounts on breakup basis. I take it again. The entity is not a going concern, and the books of accounts have been prepared on breakup basis. Then the going concern assumption is appropriate. We will give a clean report, but this time round we will give an qualified opinion, so that we introduce an emphasis of matter paragraph to emphasize to the intended users to know we have given a clean report because the books of accounts portrays a true and fair view. But again, the client faces going concern complications in the emphasis of matter paragraph. So that's what we should know. Sometimes people think that if an entry is a going concern, you're supposed to modify your report. That's not a basis of modifying. We modify if the going concern assumption is inappropriate. So if an entity is not a going concern, they have prepared on a breakup basis, give a clean report. But if an entity is a going concern, but it has got material uncertainties, their material is a 320, material uncertainties, maybe kuna kesi inaendelea kotini. If there is full disclosure, we require disclosure of these material uncertainties. Then you can go ahead to give an qualified opinion, but introduce an emphasis of matter paragraph emphasizing on these uncertainties. But if there is no disclosure, if there is no disclosure of these material uncertainties, remember that's an element of disagreement. It's an element of disagreement. You may go ahead to issue an adverse opinion if the disclosure is material, if non-disclosure is material and pervasive, or issue a qualified opinion. You qualify your report. If there are material uncertainties and have not been properly disclosed in the notes to the financial statements, it's a nature of disagreement because you feel the audit have been disclosed or the client has not disclosed. So that's a disagreement. Then others will fall. That if the client prepares the books of accounts as if it's a going concern, when it is not. These are major disagreement. Hapa kuna kuweza kitu ingine, you issue an adverse outright. That the client prepares like all is okay, when all is not okay. That's a major disagreement. The financial statements are misleading. They are totally misleading. You issue an adverse opinion. When you need more information, about the going concern complication, and the client is not cooperating, you are not availing information. You still feel that as an auditor, you feel more you need more information, you need more explanations on the going concern position of this entity, and the client is not availing this. Then you need to modify as appropriate, citing limitations on scope. What is limitations on scope? That some evidences were missing. I was not able to form an opinion properly because some evidences that are considered material and pervasive were missing. Why have I said modify the report as appropriate, citing limitations on scope? It's you as an auditor to decide whether you're issuing a disclaimer of opinion or an except for, after you assess the magnitude of the evidence which is missing. Otherwise, you are modifying the report citing limitations on scope. Yes? It depends as an array. Limitations on scope ni mara mbili. You can do a disclaimer or an except for. You except for opinion. Except for opinion. When you issue a disclaimer, when what is missing is very material and pervasive, very significant. But if what is missing is not very significant, you can talk of an except for. That the books of accounts portrays to and fair view, except for information relating to this and that was not available. Yes. So that's how we related open limitations on scope. It's you to decide as an auditor. Leo mvua imeconfuse, inanyeshaga 5 watu wakitoka job. Yes, imeconfuse 8 with 5, but it's a blessing. It's a blessing. Let me say, when forming a conclusion, on the going concern, when forming a conclusion on the going concern, the auditor should determine whether it is appropriate or inappropriate. The auditor should determine whether it is appropriate or inappropriate. Auditor should determine whether it is appropriate or inappropriate. That's what you have said. Here ndio kazi ya auditor, assessing whether it is appropriate or inappropriate. Skip a line and have Roman number 1. Skip a line and have Roman number 1. Going concern assumption appropriate, Roman number 1. Ama nimekupea ile makosa. Nilikuwa naangalia makeup nitafanya nini class. Naona vile nafunza akili kwamba trying to so we are saying Roman number 1, going concern assumption appropriate, but a material uncertainty exists. Going concern assumption appropriate, but a material uncertainty exists. Going concern assumption appropriate, but a material uncertainty exists. So going concern is about put cases that we don't know how they'll be determined. What happens in this case? So then we are saying the auditor should consider whether the financial statements adequately disclose. The auditor should consider whether the financial statements adequately disclose. The financial statements adequately disclose the principal events or conditions. Consider whether the financial statements adequately disclose the principal events or conditions, the principal events or conditions that give rise to doubts, on the entity's ability, to continue as a going concern. Consider whether the financial statements adequately disclose the principal events or conditions that give rise to doubts on the entity's ability to continue as a going concern. Is there full disclosure? About this? So A. Let's have A down there. A. If adequate disclosure is made, the auditor should express an unqualified opinion. If adequate disclosure is made, the auditor should express an unqualified opinion. Auditor should express an unqualified opinion, but modify the report by adding an emphasis of matter paragraph. Modify the report by adding an emphasis of matter paragraph. Modify the report by adding an emphasis of matter paragraph. Modify the report by adding an emphasis of matter paragraph, because it's an uncertainty. It's properly disclosed. B. If adequate disclosure is not made, in the financial statements, the auditor should express a qualified or adverse opinion. Express a qualified or adverse opinion is appropriate. Express a qualified or adverse opinion is appropriate. Qualified or adverse opinion is appropriate. All right, Roman number two. Going concern assumption inappropriate. Going concern assumption inappropriate. Going concern assumption inappropriate. Going concern assumption inappropriate. Say, if in the auditor's judgment, the entity will not be able, if in the auditor's judgment, the entity will not be able to continue as a going concern, if in the auditor's judgment, the entity will not be able to continue as a going concern, will not be able to continue as a going concern, the auditor should express an adverse opinion. The auditor should express an adverse opinion. The auditor should express an adverse opinion if the financial statements have been prepared. The auditor should express an adverse opinion if the financial statements have been prepared on the going concern basis. Express an adverse opinion if the financial statements have been prepared on the going concern basis. If the financial statements have been prepared on the going concern basis. So you've said that's a major disagreement. The financial statements are misleading. The financial statements do not portray a true and fair view. It's a major disagreement. You issue an adverse opinion. Number 3, management unwilling. Management unwilling. Management unwilling to make or extend its assessment. 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 So explain and say, if management is unwilling, if management is unwilling to make or extend its assessment, if management is unwilling to make or extend its assessments, management is unwilling to make or extend its assessment when requested to do so by the auditor. Management is unwilling to make or extend its assessment when requested to do so by the auditor. When requested to do so by the auditor, the auditor should consider the need. The auditor should consider the need to modify the report. The auditor should consider the need to modify the report. The auditor should consider the need to modify the report as a result of limitation on the scope. Consider the need to modify the report as a result of limitation on the scope of the auditor's work. As a result of limitation on the scope of the auditor's work. As a result of limitation on the scope of the auditor's work. Limitation on the scope of the auditor's work. Scope of the auditor's work. Perfect. We'll stop at that for today. We stop at that for today. So the next class is a 550. ISA 550 stroke IAS 24. This is a new topic. We've not covered it in our levels. ISA 550 IAS 24. We refer to it as related parties. Related parties. That's what we will discuss on Saturday. Related parties. It's not so wide, so we may also be able to look at management rate. We may also be able to look at management rate if we'll have some 45 minutes remaining on Saturday. All right, let's say the grace that we can find our way home. This line. Now may the grace of our Lord Jesus Christ and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. Blessed evening, be safe. Be safe. See you next month. See you next month. See you.